We have entered a period of constant uncertainty. Have we hit the bottom? Is the market going to go down another 50% and have its biggest crash in history? Or will we have another 10 years of bull market? While nobody knows for sure what's going to happen and when, people can see that the American dream is all but gone. Have a decent job, decent income, put money in a savings account and retire a millionaire. The government will care for you and your money. If any of this was ever true, it just isn't true anymore. Rising inflation means the economy is getting weaker. In June 2022, inflation hit a new 40-year high at 9.1%, 4 times higher than average. The prices are rising and money is losing its buying power. People have to pay more for goods and services, and the money they make or have is losing its value. All this has been leading us to a recession. And now that the US GDP has fallen over 2 quarters in a row, technically we're in one, although the authorities are unwilling to declare it. We will look at a system that benefits from this crisis or any crisis. It's an interconnected system of banks, the stock market, and the enormous industry of financial services that's getting bigger and bigger, and the people in charge keep getting richer and richer, while ordinary people are getting poorer and poorer. 61% of Americans don't have enough savings to cover a $1,000 emergency. 70 million of Americans don't or can't afford to save any of their annual income. Social Security is the primary source of income for pensioners, but the Social Security Trust Fund is expected to be depleted in 15 years. You used to be able to just put money in the bank and see it grow, but today, new claims of unemployment benefits are hitting their highest points. When the interest you get on a savings account is much smaller than the inflation, even if the amount grows by a little bit, your money will constantly shrink.
And that makes it very important to learn to invest. In fact, it's one of the skills of the future, because keeping money in a savings account won't help. And money managers, as you will soon learn, are there to take your money. It's a good thing we have many investing resources now. Tons of free content, free courses, free signals from brokers, commission-free trading. Or is it free? And are you free in your actions? And what's the purpose of all those financial tools we get? An estimated 20 million people started trading on their own in 2020. Maybe you are one of them. Was your investing experience successful? What's going to happen to all of us new investors? Are we smart enough not to lose on the stock market? The thing is, we are not playing against the stock market, but against the history will show. The history of losing money.
On the 20th of February 2020, stock markets across the world suddenly crashed after growing instability due to the COVID-19 pandemic. The S&P 500 fell by 34%. In March 2020, the Federal Reserve reduced its target rate range for federal funds to 0. As a result, interest rates on all kinds of loans also dropped, which made it less expensive to get a mortgage or a car loan in 2020 and 2021. The US government passed bills to stimulate the economy. These included help directed at specific sectors, cash payments to taxpayers, increased unemployment insurance, and rental assistance. As economists say, this helped the US economy recover more quickly than it otherwise would have from the largest downturn since the Great Depression. The pandemic recession turned out to be the shortest on record and lasted only 3 months. This meant we could reopen after the lockdowns, people had money to spend on necessities, their credit rating wasn't affected, people weren't getting evicted, and so on. Sounds great, huh? It looked like the government cared for its people, but actually, the Federal Reserve Bank started printing money out of nothing, as it usually did. $1.8 trillion went to families and individuals, $1.7 trillion went to businesses. If the deposit rates are close to 0, what do you do to save this money? That's right, you bring it to the stock market. According to the survey of Deutsche Bank, people plan to put 37% of any forthcoming stimulus checks from the government into stocks. In 2020, 15% of investors in the US stock market were first-time investors, and they were very successful. In the next 1.5 years, the S&P 500 grew by 86%. It didn't matter what you bought, it would grow anyway, because of the influx of free money. What's better is that everyone started earning easily on the stock market, since it had recovered so fast. That happened because of 1, extra money, 2, commission-free trading, thanks to a price war kicked off by Robinhood in 2019, 3, fractional shares, 4, easy access to leverage, and 5, because everything is accessible through a mobile app with fast connection speeds. And then there was a rise in social media, which is sort of a pandemic on its own. When making money on the rising market is so easy, everyone becomes a financial guru. And here you can see a growing number of financial bloggers who teach how to invest and trade. Let us know in the comments if the course that you bought paid itself off, or you actually lost money.
It would be unfair to say that everyone lost money. Some traders got super rich on meme stocks and crypto. In fact, the stock market euphoria lasted almost 2 years after the COVID crash in March 2020, right until December 2021. Many tech stocks grew 40, 50, 70% in 2021, so people didn't have to pick stocks, everything was just growing. Bitcoin did a 10x from pandemic lows to new all-time highs. Some traders united against the big players on social media and made fortunes on GameStop and other stocks. Did many of them manage to sell at the right time? Probably not. The reality is, the majority of those new traders didn't know enough about trading and, one way or another, lost their pandemic gains. New research from London Business School economists found that beginner day traders managed to lose over $1 billion trading options on the bull market between November 2019 and June 2021. If you factor in the costs of trading that go to market makers, this adds up to $5 billion. Is this sustainable? Free money drove prices crazy high. To see what is driving the market, one thing to look at is the weighted average price to earnings, or PE ratio. In the US market, average PE weighted by companies' market capitalization is extremely high and is at multiple of 23. For some companies like Tesla or AMD, it was over 100. It means that the company's price is 100 times more than what the company actually earns. And if the company is worth $1 trillion or let's say $750 billion, what would you have to believe about its future performance to justify this valuation? Another measure often used by economists to predict a potential price bubble is the cyclically adjusted price to earnings, or CAPE ratio. It's developed by the economist and Yale University professor Robert Shiller. The measure looks at firms' inflation-adjusted earnings per share over a 10-year period to indicate possible over- or undervaluation. As you can see in the graph, the overvaluation indicator was at its highest level since the dot-com bubble. At the end of June 2022, it was 29, just 1 point lower than the 30 mark it reached before the Black Tuesday crash in October 1929, which, by the way, triggered Great Depression. The historical mean of this indicator is 16.8. So when the market fell by 20% in the first half of 2022, it made perfect sense, because there was a bubble. And many economists warned that printing so much money is unsustainable and can lead to a huge crash. So what brought us to this? Clearly, it is not the first bubble.